Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Tony Sycamore. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with the head trader and founder of TECHFX Traders, Tony Sycamore. Tony shares with us his backstory, working on the futures trading floors in Sydney, Australia, and working on the prop desk at Goldman Sachs. He shares with us his trading process, what markets he trades and why he trades them, how he uses technicals and fundamentals, determining position size, and gives us an example of how he executes a trade. Last but not least, Tony and I discussed trading data and headlines and why he feels it's important to stay physically active outside of trading. So without further ado, let me send you right to the interview with Tony. How did you get involved in trading?
Yeah, I was going through the final year of my university and I was playing rugby down at a club, and I wasn't exactly sure where I wanted to take my career, and one of the chaps that I was playing rugby with mentioned that they were looking for a trainee on the bond desk, and the bond desk was an interesting place to start my career. But back in the mid-90s when I started, Australia was just starting to move to surpluses, budget surpluses, and the bond market effectively was slowing down at that point of time. And I thought, well, this isn't probably the type of place where I want to be situated for longevity. And I started looking at what else. I enjoyed the markets. I found that I started doing some charting and whatnot on the bond prices and bond spreads. And I found that there was a couple of guys also that were working down the futures floor that basically said, listen, we can get you down there, but you're going to have to get your own job. And I went down there as, I guess, a visitor for a number of weeks, and I got picked up by a bank called Macquarie Bank, which is an Australian bank here in Australia, obviously. And they put me on as a trainee trader. So my start, where I would really say that my career started, was on the floor of the Sydney Futures Exchange back in the mid-90s.
Cool. So that's how you got your start in the industry. Talk to us about some of the things you've done over the years to help you evolve into the trader you are today.
Yeah, so from the futures floor, it was I moved from the bond broking industry, which was going through a slowdown or a different evolvement with the budget surpluses which Australia was running, to the futures floor. And of course, around the mid-90s to late 90s, the floor open outcry system started to be phased out here in Australia and overseas. And I thought, well, okay, here I've been in this situation before, but I've always wanted to trade. So I took the opportunity to move off the futures floor after about 2 years, and I went and started trading my own account. And for the first 6 months, that trading account was going absolutely bonza. I was making money. I was able to enjoy the things which I wasn't doing when I wasn't trading, playing golf, going surfing, going to the gym, spending time with friends and family. And I thought, well, look, 2 to 3 years down the track, I'm going to be able to do this anywhere in the world. Anywhere that I choose, whether it be on a beach or an island, it doesn't matter. It's looking really, really good. And after about that 6-month mark, I started giving back money that I'd made. And the process continued to evolve, where I was giving money back. The money which I'd made and was getting so confident with started to erode through my hands. And I got to the point where I realized that perhaps I didn't quite know as much as I thought I did. And thought, well, this is probably a good time to take the next step of my career. I was still in my mid-20s, and I went and worked for I took a job with an old Melbourne stockbroking firm called JB Weir. And JB Weir had a retail futures desk. The retail futures desk was speaking to private clients about things like corn, wheat, the share price index, the S&P futures. But one of the traders there was also trading a managed discretionary fund, trading a retail fund, if you like. And through my use of technical analysis and also through my interest in trading, I became, over time, the second trader on that fund. All funds like to have a principal and then someone who can take the helm if anything goes wrong. And that was a good place to be because the fund was doing really, really well. The fund was predominantly a short volatility fund, and it was predominantly focusing on the share price index here in Australia and selling very, very overpriced strangles in the options here. And we made some fantastic money, and that continued to go on. We, I guess, got through the 2001 SEP 11 there, which it did take a little bit of P&L back. We dropped about 10% there. We were fortunately stopped out of our positions before the actual day, before the tragedy occurred, which was very, very fortunate. And there was all sorts of theories going on there that perhaps the stock market had already started selling off there because potentially some of the people involved in the tragedy were starting to short the indices in the markets there. But for whatever reason, we got stopped out of that position and we were able to continue on as we were. But in 2003, JB Weir was, I guess, taken over by Goldman Sachs. Goldman Sachs had a small footprint here in Australia, but they wanted a larger footprint. They wanted to be a player in Australia, in the stock world and also in investment banking. And as part of that merger, if you like, they got the retail futures desk, which I was part of. Now, one of the things Goldman Sachs liked to do back then was to take risk on its own account. They weren't very, very happy with their principals or their employers taking risk with client money. They didn't want the reputational risk. And after they ran the ruler through the more important parts of the business, they came to myself and my boss and thought, well, listen, you guys are doing okay. You've got some good returns here. We're going to send you off to the proprietary trading room. And you wouldn't believe the size of the smile on both our faces. We kept it, I guess, a straight face during the meeting, and literally as soon as we got out of the room, we high-fived each other, and we just couldn't wait to start. So that's really where I would consider my trading career got started, moving into that proprietary trading room at Goldman Sachs, JB Weir, back in 2003, late 2003.
All right, let's take it to current day then, and let's talk a little bit about the Tony Sycamore of 2019, and let's talk a little bit about your trading process. So got a good feel about, how you got started in the industry, the things you've done over the years in the industry. I'm curious about your process, how you approach markets. And one of the things that I think that many traders, when they start in the industry, don't take the time to find a market that fits their personality. So the first thing I want to know from you is what markets are you trading and why you are choosing to trade those markets?
Currently, I'm focusing on FX, Anthony, G10 FX mainly. And the reason for that is I have dabbled in a lot of products during my career. I've been fortunate to have the limits in all sorts of markets. But what I found was that my trading strategies, which starts with technical analysis, is more suited to trading FX, which I think is probably one of the best markets to be able to trade technical strategies in. So I focus on those markets, Aussie, Kiwi, Euro, Dollar, Yen, and that's where I'm predominantly focused. But I do look outside those markets for other leads.
Gotcha. So you focus on those markets, and you said that technicals are your lead with those markets. That's the primary part of your strategy. But are you also looking at and using fundamentals?
Yes, I am. And that's a huge part of, I guess, what I learnt during Goldman's, because I was sitting within the macro trading team there for a while, and it's hard to sit with such clever people and not pick up at least part of what they're talking about. So I tried to be a sponge in that respect. Technically was still my focus, technical strategy, Elliott Wave, candlestick patterns, you name it, I was focused on those. But fundamentals became more and more of what I needed to find to confirm what I was seeing in my technical process as well. ultimately now I'm looking for a picture where I've got the technical overlay and I can marry it with a strong fundamental view as well.
So which comes first, right? It's the chicken or the egg, right? Is it something that you're looking at on a technical basis that you're saying, okay, look at this market it's got a bullish setup for me technically. Do you then go and look to see if fundamentals fit what the technicals are telling you? Or are you doing fundamental homework and research first, saying, okay, these markets I should be looking at because this is a bullish fundamental picture, and then see if the technicals support that?
It's a really good question, and it's one which I think about a lot. I can't take a macro trade unless there's a technical reason to take the trade. For me, it's probably 40% macro, 60% technical, whereas I'm more likely to take a strong technical setup when the macro picture is less clear for me. So I don't know if it's one coming first or second, but I can't take that trade without a clear picture in my mind of the charts and where I think the market's going. And potentially that's been to my detriment because there's been some great trades out there which have been supported by macros, but the charts just haven't really supported. I mean, if we go back to last December when the S&P was in free fall, traded down to that 2316 low, it would have been impossible to actually look at a chart in a positive light. And the fundamentals, I guess, were starting to change there. We had the Federal Reserve becoming a little bit more flexible in terms of its outlook, and there became more noise towards a positive resolution with the China-US trade talks. But the technical picture at that time absolutely stunk, and it wasn't till really, I think, the 26th of December we got that sharp rally. And I use Elliott Wave a lot in my technical process, and until the S&P really broke back up through 2600 to 2625, I couldn't put a positive spin on the rally. Since then, sure, I've been able to do that, and now we're sitting up at that 28.15, 28.25 resistance area. I'm a little bit undecided now where we go from here. Potentially, we've moved over 500 pips, 20%. We're due for a little bit of a pullback. So I'm aware of that, but at the very start, it's still got to start with the technical picture for me.
Okay, well, let's focus a little bit more on the technicals. I think everybody understands you're looking at technicals first, as you mentioned, probably 60-40 leaning more technicals. And
Correct.
We know you're looking at FX markets. Talk to us about a couple of things here. Favorite indicators and also the time frame, your average hold time. Are you trading dailies, weeklies, intraday? Talk to us about that.
Sure. Let's start with the time frame first because it's evolved for me, and maybe that's got to do with me getting a little bit older and a little less nimble. But back in the Goldman's prop days, we were in and out of markets pretty much well within 24 hours. We were finding our entries, hitting it hard and getting out, and hopefully taking money off the table and doing it all again the next day. I don't really want to spend all my time sitting in front of a screen anymore. And potentially towards the end of that Goldman's career, I was starting to get quite burnt out and getting sick a lot of the time. So when I got back into this role, I decided that my trading style needed to evolve. And as part of that, the time frame for my trades have actually become broader. So the time horizon of my trades, I'm typically putting trades on, which might be anywhere between 2 days and 2 weeks. And instead of going for those sort of 50 to 80 or 100 pip moves in FX, I'm still happy to take a 50 pip move if that's what the technical picture has said that I should be after. But more likely now, I'm looking for somewhere in the range of 150 to 250 pips, which in this type of market isn't really easy at the moment. The markets have been, particularly something like the euro, for example, the euro's been trading sideways for the better part of 3 to 4 months now. So you're not getting those moves, but we're in a 300 pip range. We're in a 112.15 to 115.70 type range. So there is room within that range if you're patient. But from now on, for at the moment, and since I've become more into, I don't want to sit in front of that screen, and that's something which is really, really front and center in my mind. So I'm looking to put, smaller trades on, trades with smaller size, bigger stop losses, and looking for bigger profit targets.
Okay, then talk to us about your technical indicators. Which ones are your favorites?
Yeah, I started with my Elliott Wave back on the futures floor. Macquarie Bank had a fantastic chartist there who used Elliott Wave principally, and it became a large part of what I do. But I've also incorporated other things as I've gone along. Candlesticks, which I love, and part of that was having met a chap called Dan Gramser. back when I was working at Goldman's, I went to a couple of seminars he took, and it was very clear to me the way that he conveyed candlestick analysis, that there was a connection between his seeing the candlesticks on the chart and his time spent on the trading floor back in Chicago. The emotion which we used to have around us on the trading floor, the greed, the fear, the panic when there was a bad data print, or the excitement, people bidding over each other, trying to get set. Where's the offer? I'll buy 50, I'll buy 100. That was conveyed to me in a similar sense through the candlestick pattern. So I don't know every candlestick pattern. I'm looking for about half a dozen particular patterns which I think work quite well. I love using RSIs for things like divergence. I look at moving averages because I know that people who are more macro orientated always, well, not always, but a lot of them will look towards moving averages to get a guide of whether a commodity is expensive or cheap. So it's a blend, but it always starts with the Elliott Wave analysis for me, and I'm big into candlestick patterns. I love RSIs. And integrating some of the fundamental overlays, which we spoke about earlier.
Okay, so I want to stay on the technical indicators for a second here, because I think a lot of people can be overwhelmed by all the different indicators. You talked about 4 specifically: Elliott Wave, candlesticks, RSI, and some moving averages. Mm-hmm. Paint a picture for us. How are you using Elliott Wave with candlesticks, with RSI,
Absolutely.
with moving averages, or are they all used independently, and then you say, okay, this is you put that kind of puzzle together? How does it all work?
Yeah, I'm trying to get 3 or 4 of those indicators or technical analysis techniques all lining up to support a trade, because I feel that if I've got 3 or 4 of them all on the same page, there's a better chance of me having a winning trade. So the Elliott Wave analysis, I think Elliott Wave analysis can really, people can get bogged down in it. It can become unusable because it is quite technical, and I wouldn't call myself a pure Elliott Wave person. I'm looking for really clear wave counts. If it's not clear, and if it's subdividing into something which becomes more complex than what I'm looking for, I move to a market whereby I can find more clear wave counts, if that makes sense. I don't want to get bogged down into ABCXs and all that type of stuff. I'm looking for impulse moves higher with corrective pullbacks. And once I find a market that is doing something within that Elliott Wave framework where I can identify our impulse waves, the trends is higher, I'm looking to buy corrective pullbacks. That's my mentality. I'm not a breakout trader. I find that breakout trading is good for some people, but for my personality, I want to find that uptrend and then wait for the pullback. And then when I find that pullback, I'm looking for particular types of reversal, loss of momentum candlestick patterns, which might line up with, for instance, Fibonacci's, or it might line up with some divergence on RSIs, might line up with pulling back to a moving average as well. And the more of those things I can get to line up, the better. But the candlestick patterns and the Elliott Waves are really, really important for me. I probably wouldn't take a trade unless both of those 2 things lined up. If I could get the RSIs, the moving averages in there as well, then that gives me more reason to take the trade.
Gotcha. Now I can see what you're looking at. You're looking at the Elliott Wave as the first tool, right? And then you have, once that shows you something, then you're looking at candlesticks, RSI, or moving averages, basically to confirm that. Are those confirming indicators?
Correct, absolutely. But I'm not, so for instance, with the euro, we just spoke about the euro, that's been in a sideways range for 3 to 4 months. I'm not going to leave that market alone if it gets to the bottom of the range or the top of the range. If I have a view down there that towards the bottom of the range, which I did recently in the euro, that we were going to push back up towards 114, I will take that trade. Now, that wasn't really an Elliott Wave trade, but I think Blind Freddy could put together a parallel trend channel there and see that the euro was in pretty tight confines there between that 115 and 112 area. And for me, it gives you the opportunity to put a trade on with a very clear cut stop. And that's what I'm looking for. I'd love to find, it might not be in that Elliott Wave framework, but if I can find through my chart work a setup with a clear cut and low risk stop, that's what I'm interested in as well.
And that comes with experience, right, Tony? I mean, over the years, you've looked at a lot of things, so you have a great feel for the market. So sometimes, such as what you were talking about with the euro, you're looking at that going, look, I have my fundamental story. Nothing may come up on this Elliott Wave, but I've seen this type of look before. So you look
Correct.
for low risk setups that you feel that you could go in and just trade. Now, I get that.
Exactly.
Let's talk about execution, because I talk about this a lot, because I tell everybody all the time, you could have the best strategy in the world, and if you don't know how to execute it, there's an art to execution. Then it doesn't matter. And if you do have a strategy that's so great, I tell everybody, then just automate it. Because then what do you even sit there trying to push a button for? Because if it's so good, you should just take the human element out of it. But we all know, Tony, as you've been around like I have, that the edge a lot of times that we have as traders, and I think what you were just talking about, the edge, one of the edges that you have is you've seen things. You've seen scenarios where you know that you could take advantage of them. You can't program that, but you could take advantage of it. So
my edge is me, much like your edge is probably you and your process and your history in markets. And I'm fortunate now. I get to speak to a lot of traders, private traders, and find out what they're doing. And I've had a few very smart people come and say, I'd love to sit down and automate your strategy. And I don't feel that it can be done. And it's something which I'd love to be able to do, because it would obviously make my job and my life a lot easier, but I just don't feel. I mean, if volatility gets too high, if the VIX spikes up above 25, you'll find that correlations will break down. If volatility is too low, then potentially you've got to adjust what you're looking at as well. I feel like markets are just constantly evolving, constantly changing, and I think there's a big hoo-ha about AI a couple of years ago being fantastic, the best thing for markets since Swiss cheese. And I keep an eye on the returns that some of these AI funds are doing, and they haven't really done anything spectacular. In fact, they looked through 2018, they looked very correlated to your CTA type systematic strategies, your breakout strategies, your breakout traders. And I think that's because they're using the same data set, past history that the CTAs are, that we're using. And I don't think they're finding anything unique in there. And I think the other part of that is us, the human part of markets, is always changing. Now, maybe I'm wrong. I'm not strong in computer programming. That's not one of my fortes. But for the time being, I feel like they're just replicating what some of the systematic strategies are already doing, and they might be replicating what you and I might see in the charts, for instance.
Yeah, I don't disagree with you on that. And going back to execution. So something that I think is really important in my trading is knowing when to trade big, when to trade small, or not at all. And I've talked about this a lot.
Yep.
So talk to me about your process for entries. Are you scaling in? Are you in all at once? Are you always trading the same size? Are you trading different contract size? Like, how do you determine contract size?
Yeah, it's a great question. And I've been a little bit on the wrong side of Murphy's Law when I've been on a good run and then I've found that, right, this is the one I'm going to hit it out of the park. It's inevitably been the one which actually caught me on the backside. So what I've done now is I try and keep as my risk to a standard size. I think one of the things private traders don't have quite as good access to is option markets, where if you're a professional trader and you want to hit one out of the park, you can do that through an option strategy. It's not quite as available to private traders in FX that I find, particularly the smaller FX traders. So it makes it hard to go, right, look, this is a perfect lineup for me. I'm going to put a little bit of cash on and I'm going to put some optionality around this strategy. That's not, I don't think, available to your private traders in your standard account size. So and for me, as I've said, I've had this Murphy Law type experience. When I have been on a good run, I thought, right, let's knock this one out of the park. It's always been the one which I've been struck out on. So now my process is that if I see a trade that I like, I'm keeping it to within that 1% of my account size risk parameters. It might be half. If I've been on a losing run, I'll actually scale it back down. I'll pull it back down to 0.3 or 0.4% until I get my eye back in. But it's always below 1% because for me, I just haven't had that success with absolutely nailing that big trade, which, comes from, I think, again, it's a personality thing. If you've got that track record and you feel comfortable having a go at a market, that's fantastic. So, for example, in Dollar Sing, Dollar Sing was a market which I was looking at closely at this start of this week, and I identified a buy zone where I wanted to buy dollar Sing and get up to my full 1% allocation, if you like. Unfortunately, it only just edged into the top of that buy zone, and then it's bounced out of it again. And I haven't got on my full size, which is a problem. If it continues to go higher, then I have to work out where I'm going to add to that. If it comes back lower into that buy zone, then I can take my full trade size. Trade size for me is worked out by that 1% and then how far away the stop loss is going to be. And obviously, the closer the stop loss, the bigger the trade size I can take. So yes, I do. The answer is yes, I do scale in, and I am trying to build a position. I don't go in there all at once very often. I'm looking at where I can add to a position within my guidelines. When I'm getting out of a trade, exits for me are the most discretionary part of trading. And I think you could have this conversation with probably 50 different people and get 50 different answers. But I like to trail my stop loss up when the position goes in my favor. I'm trailing the stop loss up, and I'm looking to scale out of trades at predefined levels as well, which I think gives me, I know a lot of people, when a trade goes the right way, will start to add to that position. For me, the risk reward starts to break down unless you can find a good place to bring your stop loss up to. So more often than not, I am scaling into trades and I am scaling out of trades.
Let's stay on the exits now. Do you have a target already in place that you're looking at and saying, this is where I think it can go? Or do you have multiple targets to say, this is where it may go? So that's how you start to scale out. And also,
Absolutely.
describe the process, if you have a consistent process for trailing the stop on the exit.
Yeah, the stop's probably the most discretionary part of it as well. And I will try and work out what the volatility of the market is and put the trailing stop below the volatility of that particular market, so I don't get triggered on a random pullback. So it's probably the most subjective. Again, it's one of these things where if you're trying to program my strategy, it's not as easy to do because there is a lot of subjectivity into that. But at the start of the trade, and I sit down each week and go through all the markets that I look at, do my analysis. I start with the monthly and the weekly charts. I then drill down onto the dailies and potentially the 240 minutes. And within that process, I'm looking at where I can find my setups and where I can find a good, acceptable risk reward ratio, whereby I might be looking to risk 60 or 70 pips in a currency pair, and I can see there is potential for it to move that 150, 250 points that I'm looking for. That said, I might take out 1/3 of my trade size. Once it reaches that first 60 pips, then I might look to take out the next part, another 1/3 of my trade size once it reaches potentially 120 pips, and then I'll keep that third and final partial part of my position size as what I call a blue sky type parcel. And by that, I want that to work for me. I want that to become the parcel which, if the trend really takes off, I'm still involved in this market. If it pulls back, well and good, then I've still done quite well in the trade, and potentially I can look to re-enter that trade on those parcels which I've already exited. And again, it's one of those ones where people will tell you, don't trail your stop loss up, don't take profit at predetermined points. But for me, it works for my personality. I want to get paid. I want to lock some in each day. And I don't want to be the guy sitting there going, well, hey, that market just went 100 pips in my favor. Sure, it didn't get to 150 or the 200 pips I was targeting. And then it's come all the way back and stopped me out either at my break-even stop loss or at my original stop loss. So I am conscious of putting some money in my pocket where I can.
Well, you nailed it. It's based upon your personality. And this is something that I've discussed a lot in this show and on social media, is that if it's not a strategy that fits your personality, you're never going to be 100% in mentally. Because part of the way through the trade, you're going to be checked out. And like you said, you can't do something that doesn't fit you. So when you're looking to take profits, your guts, your instincts are saying, I should be doing something here. Some people just like to hold trades. Some people like to be in and out really fast. So embrace that, right? I mean, yeah. Why fight it? I don't understand why anybody out there would say that there is a right way to do this for anyone. You have to do what fits your personality best. So I want to talk about trading data, because this is a conversation that you and I had on a different call, and we were both talking about how we used to gear up for trading numbers, unemployment or a Fed number, and I used to love trading those days. They were really a big part of my bread and butter for a long period of time.
Bring back those days, I say.
Yeah. Nowadays, and for many years now, I don't know how long it's been, but it's been a while since I've really looked at a number and said, okay, I'm going to trade this right as it comes out. I let the number come out, wait to see what happens. And to me, you said that you do the same thing. Talk to us about how you go about trading data these days.
Yeah, back 10 years ago, it was so easy, as you mentioned. You didn't need to take a position into the data, particularly in FX, because there's the corporate accounts which leave their bids and offers, and they're not actively trying to generate alpha. They're just doing the business which their underlying business demands. So they're not too fussed about getting the sharp fills which you or I might be looking for. And because of that, and with the advent of electronic trading, you could wait for that data to come out and you could get set at really good prices. And usually once the market had digested that data and your initial read was correct, the market would continue to run in that direction. Now, fast forward 10 years to where we are now, and the algorithms and the systematic guys are a lot quicker and a lot more disciplined in terms of being able to access the markets with their, the flash boys. We've heard about the flash boys being able to get in a lot quicker than you can. Simply, you can't win that race anymore. So we have to evolve. And I think there's two ways to do that. The first is if we have a good trade setup and we've got data coming out, and it's inevitable that we have data coming out in this day and age. There's usually tier one data coming out every second or third day here in Australia or the US or wherever we might be looking. So we can't avoid data. We can't wait and we can't avoid it. So what I look to do is to take, if I have a high conviction view that this technical setup is worth me taking the risk of running a position into the data, I'll take a small position in. Obviously with a wider stop, because I don't want to get flicked out on some random headline. With employment data, for instance, you get the headline number, and then you get the unemployment rate, then you get the participation rate, and you can get very, very whipsawed around on those types of releases if they don't all come out at once. So I'll look to take a small position in if I have a strong view. And then once that data comes out, I'll wait for the algos to reprice, which usually happens within 4 or 5 seconds, where they think the market should be. After that initial buying comes through or that initial selling comes through, it then goes quiet for a little while, and the market tends to give back some of its gains. It might not give back all of the gains, and if the data is really strong or really weak, it won't. Most definitely it won't. But I'll be looking for what I call a pullback before the second wave of buying comes in. And that gives me the opportunity to top up on my original position, and that's what I'm looking to do over data now, because as I said, you can't avoid it. It's made trading for us a little bit more difficult, but there is ways around it.
Last thing before we get into rapid fire, do you use any sort of trading psychology, trading coach? Like, for example, for me, I meditate a lot. I'm always exercising and doing things. I feel like what I'm doing when I'm not trading helps me a lot for when I am trading. Do you do anything like that?
Trading psychology, I don't particularly do, but I agree with what you're saying. I find that getting out and about, and I like staying active, and I participate in paddleboarding and tennis, and might go for a bike ride and do some yoga. It's funny, some of the sharpest and best market thoughts I have are when I'm not in front of the screen, bogged down by emails and bogged down by watching a market move. And it's not strictly psychology, but certainly it is time whereby that I get a lot of rejuvenation from the markets, and I get a lot of good ideas coming through as well.
Great stuff, Tone. We got rapid fire segment questions next if you're ready for those.
Okay, yep, let's do it.
All right, everybody, our rapid fire segment is sponsored by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. First question, Tone. What trader has influenced your life the most and why?
Yeah, it's a good question. I've been really fortunate, as I've mentioned, working in the trading room of one of the biggest banks in the world. And In that time, I've worked with some amazing traders who at different points have had really huge impact on my trading style. So I probably wouldn't want to name a few of those people. They probably wouldn't appreciate it, but I've been lucky to meet and work with those people. Dan Gramser was a person that I've mentioned. I have been to a couple of his webinars. I think he's fantastic as well.
What was one of the hardest things for you to overcome in trading?
Yeah. In my early career at Goldman's, I just wanted to short stock markets. I was a serial shorter of equity markets. And I sat down one year, I was also trading FX and other products, and I broke down the asset classes where my P&L was coming from and where it was being taken from. And I found out that, well, I confirmed what I knew. I was losing money in stock indices. And I went in one day, I went to my trading manager and said, I need you to take away my limits in the stock indices. As much as I love these markets, they are detrimental to my P&L. And as a trader, P&L is what it's all about. He looked me in the face, basically refused and said, Tony, you got to learn self-discipline and you got to understand where your edge is. And he left me with those limits. I think I'm probably the first person that ever asked for limits to be removed. Usually traders are asking for more limits and bigger limits, but it became a real pinnacle point for me as well. And that was one of the hardest things, to wean myself off those stock indices.
How has your trading process evolved over the years?
Yeah, I started out purely as a technical trader, but after spending more and more time with some of the macro team at Goldman's, I became more comfortable taking risks and really looking for trades where there was a good technical story in place and a good fundamental story as well. So I need to find both of those things in place now to find a good trade, and that's been the biggest involvement for me.
What is one attribute that you believe every trader should have?
I think discipline. You have to be disciplined and you have to have a strong work ethic for this. I see so many, I guess, you can learn to trade by doing this course or by doing this weekend course or whatever, and then you can trade in 10 minutes a day. I think it's absolute nonsense. I think you have to have a strong work ethic and be prepared to put that work in and have the discipline that goes with it.
Favorite book about trading?
I just love Pitbull by Buzzy Schwartz.
Favorite movie about trading?
The Big Short.
What's the best piece of advice that you've received about trading?
Yep, I was in a bad run at one point of time, and my manager at Goldman's came in and pulled me into the meeting room and said, we had a good chat, and at the end of it, he said, Tone, just look after your downside and the upside will look after itself. And that, to me, is still one of my guiding statements or advice, if you like.
If you could go back in time and give the younger you a piece of advice, what would it be?
Yeah, that's, well, I spent a lot of time focusing on technicals. I would be quicker to incorporate fundamentals, and I would be also more aware of the importance of central bank policy, how central bank policy can change and the effect it has on markets. And for us sitting here in Australia, the rise of China, as in other areas of the world, has just been so important. I don't think there was many people when I first started trading that really understood what the rise of China actually meant, at least in the trading world. I'm sure there was people out there in the geopolitical world who could see it happening. But for us traders, sometimes we've got short attention and a very narrow focus. That was something that I wish I was a little bit more onto earlier.
If you had an elevator pitch me your edge in trading, what would it be?
Yeah, okay. Markets, complex, they're constantly evolving. And I think through all that, price is one of the most reliable and consistent things to watch. And for that reason, my process always starts with price and technical analysis. However, I incorporate other analysis techniques, as mentioned, fundamentals and intermarket analysis, to really try and pinpoint those high conviction trading views. But above all, it must be balanced with acceptable capital exposure. You don't want to be the guy that loses 10%, 5 trades in a row. You're in a hole and you've lost your job.
Last question for today. What's your favorite thing to do when you're not trading?
Absolutely. Getting out of the office, going for a paddleboard. I live in Manly here in Sydney, so we've got some fantastic waterways, surfing, tennis, gym, bike riding, you name it. I'm just happy to get outside and exercise, get off my backside, and of course, spending time with family and friends.
Tone, where can people find you on Twitter, and give us a website to check out?
Yep. So my website is www.TechFX I am on Twitter at Tony_Sycamore.
Tone, what could I say? This was great. Thank you so much for joining me.
A pleasure, Anthony. That was awesome. I really hope it brushes up well for you. And it was great. Thank you very much.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.